First of all, good evening and welcome to everyone. I'm glad you made it out in this weather. It's nice to be up here and speaking to you this evening. I fought to go first so that I could be before David and not have to follow him, given his speaking abilities. I'm a portfolio manager here and a partner. I've been with Baskin Wealth Management now for 10 years, coming up on my anniversary. Many of you here know me quite well because I deal with you personally. For those that I haven't had the pleasure to meet yet, I would just say there's some basic information in the inside of our booklet that you can read about me, but please take the time and come over during the cocktail hour and introduce yourself. I'd love to meet you. Today I'll be providing a high-level update of basically our business model, as well as discussing what it is or what it means to be a Baskin Wealth client. Quite a meaty topic, actually, so this could take the whole hour. I wouldn't dare do that to you, and I've committed to my partners that I'll keep it under 10 minutes, so here we go. The more things change, the more they stay the same. So this is a quote that we've all heard at some point in our lives. For the purposes of my discussion, I wanted to break that quote into two parts. So the first part is the more that things change. It's hard to believe, but this is our 10th Outlook presentation. Over the course of 10 years, much has changed in our world, in our industry, in our business, and even our outlook has changed. Our first Outlook was held at our offices on St. Clair, where we hosted approximately 50 clients over the course of 2 evenings. Today, this is our 4th venue, and there are well over 200 clients with us this evening. So consider all the changes that have taken place over the last 10 years. Quite amazing, really. I mean, too many to make a list. From geopolitical events, the Greek debt crisis, for instance, what's going on in Syria, natural disasters, tsunamis, earthquakes, wars. We even experienced a financial crisis in 2008. I'm not going to ask you how many remember that. I'm pretty sure I know what the answer is. There's also been changes to our financial markets, your portfolios, and our firm. So when I started in 2006, we were managing assets of just under $200 million. Fast forward to today, that number is now in excess of $800 million of assets under management. So consequently, there's been changes to our business, new additions to our team, which David walked us through. There's new investments in our technologies. There's also been changes to our regulatory environment that impact how we interact with you. So some of these include such things as AML or anti-money laundering legislation, CASL legislation, the anti-spam. This year's favorite was, of course, FATCA, and coming down the road is a thing called CRM2. Finally, amidst all this change, we changed our name as well, which we announced last year. Now to the second part of the quote. The more they stay the same. Despite all this change, some things do stay the same. The way we manage your money stays the same. The way we manage our business has stayed the same. We have stayed true to our core. So our business is built on 3 pillars. There's the portfolio management, which is building wealth and protecting your capital. There's the service, which is part 2. We take that very seriously as well, and that's providing a superior client service experience. The third part, or the third pillar, is we take a team approach to both of these. So the first pillar, portfolio management. For over 20 years now, we've applied a consistent approach to investing. At the same time, different investment styles and trends have come and gone. When it comes to managing your money, there are 3 areas that we focus on at Baskin: research, portfolio construction, and portfolio maintenance. Very important to note that all of our research is done in-house. Our investment committee, which consists of the 3 portfolio managers and our junior analysts, the committee identifies investment opportunities and then directs our trading and our research accordingly, but only after the portfolio managers agree. You've probably heard us say that we are investors, not traders, that we're value investors, that we take a top-down macro view as well as a bottom-up view. David is going to be providing a top-down view this evening, and Barry's going to give a great example of a bottom-up stock selection that's done very well for us. So now we have our view of the world, and we have all these wonderful companies we want to invest in. How does this tie into your portfolio? So the answer to that question is through portfolio construction. This is the job of the PM, the portfolio manager. The PM will take the directives, the decisions, the views of the investment committee, and then overlay the unique set of circumstances of each individual client and come up with a custom portfolio. Portfolio construction is a critical step for every portfolio that we build. And this is why we take the time up front in the relationship to really understand who you are and what your needs are. So we'll develop that investment policy statement, which is all that know your client information that addresses your needs for capital preservation, income growth, your risk tolerances, your liquidity requirements, and so forth. But part of this process, we go through and we determine several things that have a dramatic impact on your portfolio's performance. So the obvious one, the first one, is overall asset allocation, so the mix between equities and fixed income. The next is sector allocation. So for instance, our decision to go zero weight precious metals, commodities, mining, energy has served us well over the last 2 years. Geographic allocation, again, our decision to increase US names over the last 5 years has served us well. And then there's the overall level of diversification, or the number of names that end up in your portfolio. So once a portfolio is built, it still needs ongoing maintenance. So even though we say we're not traders, we're active in the management of your portfolio. So your PM will monitor the portfolios on an ongoing basis and make the adjustments throughout the year. Now, these adjustments will be driven from issues on your side, whether they be changes to your client profile. Maybe you've retired, you've sold a house, maybe you've added money, there's a buildup of cash, or it's on our side where we've had changes or decisions made by our investment committee that impact your portfolio. Now to the second pillar of our business, and that's service. As David mentioned, we take this seriously too. We look to provide a high level of service at every touch point. Communication is the key to doing this well. We understand that communication is a two-way street. Therefore, we will meet you annually at your annual portfolio review meeting to discuss the portfolio. We also provide access directly to the portfolio managers throughout the year. So if you look at the graphic on page 4, we've listed here a bunch of ways in which we communicate to you. The two that I wish to highlight right now are, the first one, reporting. Our objective with our reporting is to be as transparent and as formative as we can for you, because we want you to be well aware of exactly what's happening with your portfolio. The second I want to bring your attention to is the APRs, so our annual portfolio meetings. They're important for both us and for you. So the APRs ensure that your portfolio is still designed to meet your needs as they stand currently. It also ensures that we're up to date on all the developments in your world that change what we have to do for you. Finally, it gives you a chance to ask any questions that you may have. So ultimately, the better that we know you and we understand you, the better we can manage your money. Now the third pillar of our business, and that's that we take a team approach to both portfolio management and to service. As you can see, we couldn't resist, if you're looking at your booklet, we couldn't resist putting in a picture of the Blue Jays. It would have been better, of course, if they're still in it and playing tonight in the World Series. However, it's still a great example of how teamwork can lead to success. And that's our view. So our team approach results in consistent returns and a consistent client experience across the board. So we've got some examples listed here as well as to how the team approach applies. On the portfolio management side, you'll see that we've already discussed the role of the investment committee and that it makes decisions as a team, that the PMs in the firm will ensure that the decisions and the philosophy are rolled out across the client portfolios. On the service side, we promote a culture, a consistent culture throughout the firm. We also, and I'm saying this twice because it's that important, we also provide you direct access to the portfolio managers or the decision makers on your portfolio. So for you, the client, this means two things. One, strong performance from a custom portfolio. Two, a high level of service. And hopefully a high level of client satisfaction. The takeaway here is that we value and appreciate your business, and that we have a team of professionals here, a growing team of professionals, that are looking to make that whole experience better for you every day. So again, I'd like to thank everyone for coming. Please enjoy the rest of the evening, and I'll pass it over to David.
Makes you wonder why we've been hiding him for 10 years, doesn't it? So for those of you who've been here before, you know that the economics lesson is about to start. And for those of you who've never done this, trust me, it doesn't hurt a bit. It's actually kind of fun. So I'm going to be referring to the graphs in the book. So I'd ask you to open, please, to page 6. Somewhat ominously, we've titled the lead section, "The Economy Has Fallen and It Can't Get Up." That doesn't sound so good, does it? What do I mean by that? Well, I'm going to start by asking a question of everybody here tonight, and I can't see everybody, but I can see a lot of you. And the question I'm going to ask is, how many of you, when you bought your first home, had a mortgage over 8%? From what I can see, that's a lot of you. People now, when they buy a home, have a mortgage of 2.5%, or maybe less, maybe 3%. All of us who bought our first homes and had a mortgage of 8% think that there's something strange going on, that things are abnormal. What I'm going to talk about tonight in the next half hour or so is my belief that, in fact, the experience of many of us in this room who grew up and reached adulthood and became productive workers in the economy between, say, 1950 and 2000, that 50-year period that we think of as normal was in fact an abnormal period. It was not the norm. And what we may see in the next 50 years, and I don't hope to forecast 50 years, I'm happy to forecast 50 weeks at a time, but what we may see is going to be different than that 50 years. So let's start on page 6 with what's going on now, because if we don't know what's happening, it's even harder to predict what might happen next. And what's going on now is that we have weakness in all of the major developed economies of the world, in North America, in Northern Europe, and in now what is by some reckoning the biggest economy in the world, being China. So if you look at the graphs, what you will see is that very disappointing growth in the last few years. We all know that in 2008, the world went into a deep recession caused by the financial crisis, and everybody, well, almost everybody expected that there would be a strong recovery coming out of 2008. Here it is, coming towards the end of 2015, 7 years later, there has been no strong recovery. The fastest growth that we have seen has been sporadic quarters of 3.5% or 4%, but much more often 1.5% or 2%, or as we saw in Canada in the first half of this year, negative growth. As we all heard ad infinitum, it seemed to me, during the election campaign, Canada did in fact slip into recession in the first half of the year. If you look at the graph for the economic growth in Europe on the top of page 7, what you will see is that there is none. There is no economic growth in Europe. And if you look at the growth in China, what you'll see is that that economy, which had been the locomotive carrying the world economy forward, is struggling to make 7% growth this year and may fall to the 5% region a year or two for now. There's no question, it's indisputable, ladies and gentlemen, that economic growth in the developed world has slowed. It hasn't quite stalled, but it has slowed. And bear in mind that this is with all of the monetary stimulus that could be possibly provided, in as much as interest rates are effectively zero for short-term money, and the government of Canada can borrow money for 5 years at less than 1%, can borrow money for 10 years at less than 2%. Monetary stimulus is about as strong as it could be, and this is even more true in Europe, where interest rates famously went negative, and certainly now true in China, but it's not enough to get the economy moving. So the question is, why is that? If the economies are slow, if the economy has fallen down and it can't get up, why is that, and is there anything we can do about it? Please turn to the next page, 8. One of the things that's happened, and demographers saw this coming from a great distance, is that our populations in the developed world have aged. Canada, for the first time, according to Statistics Canada, now has more 65-year-olds than it does 14-year-olds. If you look at the bars on the very left of the graph at the top, the 65-year-olds are in yellow and the 14-year-olds are in that dark blue, and there's now more seniors than juniors, if I can put it that way. That never happened before. The effect of aging population is very, very crucial for understanding what's happening in the economy. Younger people get married, they form households, they buy houses, they furnish their homes, they buy cars, they consume. Older people sell homes. They retreat to a smaller lifestyle, they spend less money. When we have an aging population, economic growth is very difficult to come by. So it's not just Canada at the top of the page. Look, for example, at what happened in China as a result of the one-child policy. The population pyramids at the bottom of that page ideally should be pyramids. That is to say, there should be more young people at the bottom of the chart and fewer old people at the top. But what you see in China is a middle-aged bulge, thin legs and fat hips, if I can put it that way. Some of us in middle age have that problem. But China certainly has that problem. As a result of the one-child policy, you can see that there's a shortage of people under 30, but there's lots of people over 50. The world-leading demographic disaster is, of course, Japan, on the top of the facing page. I just want to go through this for a second so you can understand just how horrible the situation is in Japan, which has been in continuous recession for more than a decade, and how horrible it's going to get in the next 50 years. If you look at the population pyramid on the left, titled 1960, you will see that there were over 2.5 million kids in Japan, people under 15. That's the yellow-oranges section. Fast forward to 2010, and you can see there were just over 1 million children, and fast forward to 2060, and there will be but 500,000. In other words, 20% as many kids as there were 100 years earlier. Now, Japan is the horrible example because Japan is 99.9% Japanese. The Japanese have chosen not to embrace immigration. In contrast is the United States at the bottom of the same page, which actually has almost a healthy-looking population period for 2 reasons: immigration, both legal and illegal, and I guess if Donald Trump gets to be president and builds a wall across the southern border at the expense of the Mexicans, that might change. And also because a lot of the new immigrants to the United States have more children, at least in the first generation. So the United States demographics are more healthy than certainly Japan and China, and actually slightly more healthy than those in Canada. But we can't over-exaggerate the detrimental effect of bad demographics on future economic growth. And sadly, ladies and gentlemen, once your demographics are bad, it's difficult to change them unless you embrace a wholesale policy of mass immigration. During the 2008 housing crisis in the United States, I said the United States could solve its housing crisis easily if it brought in 5 million immigrants from the rest of the world who wanted to move to the United States, all of whom would need a place to live. Could have solved the problem in 1 year. Not necessarily economically palatable. If you look at page 10, I want to talk about a number of other things that have impacted economic growth in the developed world. One of them is the revolution in communications and transportation, which has made it possible to make goods in countries where labor costs are very low. I think everybody in Canada is aware that manufacturing jobs have migrated to Mexico, partly as a result of NAFTA. But if you look at the chart at the top of the page, you will see that the developed world has very expensive labor costs for manufacturing. The Scandinavian countries, over $50 an hour. North America, all in with benefits, over $35 an hour. And if you compare that to the emerging economies, not only in Eastern Europe, but in Southeast Asia, the Philippines, Indonesia, and Vietnam, which aren't even shown here, where compensation costs are a small fraction, in some cases less than 10% of the manufacturing costs in the developed world, what you will see is that inevitably manufacturing jobs and the good wages associated with them have migrated out of the developed economies into the emerging economies. And if you look at the graph at the bottom of page 10, which shows you the number of persons employed in manufacturing in the United States, what you can see is that number has fallen off a cliff. And like the economy, it's fallen down and it's never going to get back up. Too much competition. If people in the developed economies aren't working in manufacturing, what are they doing? Well, famously, of course, politicians say they're burger flippers. Well, they're not all burger flippers, in fact, but they are in service industries. And if you look at the graph on the top of page 11, the red line shows you the growth of employment in the service industries, and you can see it's striking, whereas the blue line shows you what's happened to all other industries, and that would include construction as well as manufacturing and mineral extraction and so forth. The West, North America, Western Europe, have become service economies. We cook for each other, we wash windows for each other, we do dry cleaning, but we don't make machines very much anymore. And the fact of the matter is, service workers make less money than manufacturing workers used to make. And the fact of the matter is, in the North American economies, service workers have not had a raise in 10 years. If you look at the graph at the bottom of that page, which shows wage growth for all employees, what you will see is that average hourly earnings after inflation are essentially zero, and people are not getting wage increases. So, if you have bad demographics, no youngsters starting new households, if you have a workforce that is not getting a raise so that it cannot increase its consumption, how can we expect the economy to grow? The answer is you can't, and that's why I've come to the conclusion that for the foreseeable future, we're going to be living in a low-growth world. So that has a number of implications, and of course, our job is to make you money, whether we're living in a slow-growth world, a fast-growth world, or whether we're in neutral. So we're going to talk about how we can do that. And one of the things we have to understand is that even though we're in a low-growth world, the world is awash in extra money. For one reason, of course, it costs almost nothing to borrow. If you can borrow money for 90 days at less than 1/4%, there's going to be a lot of money in the world. The second reason there's a lot of money is that companies are not investing their extra cash in new plants and equipment. Why not? Well, if you think about it, if there's not going to be demand because the economy is growing slowly, you don't need to build many new factories, you don't need to invest in new plant, and the money just piles up. So if you look at the chart on the top of page 12 with the pretty green bar graph, green because that's money, that's cash piling up, and you can see that corporate cash in the United States, and this is outside of banks, this is non-financial companies, this is the Apples and Googles and Microsofts of the world, has increased by 117% in a 7-year period, more than doubled the extra cash that these companies don't really know what to do with. One of the things they've done with it is buy back stock. And if you've been following our newsletters, you know we like companies that buy back their stock. And if you look at the graph on the bottom of page 12, you can see that the stock buybacks have been enormous and continue to be so. And that's one of the things that's happened to that extra money. But I also want to talk about interest rates again because they're so important. Money is like everything else. It's like iron ore or coal or a barrel of oil or an ingot of copper. It reacts to supply and demand, just like everything else. So we know there's a huge oversupply of money. We can see it, the graph at the top of the facing page. We know that there's not much demand for money. Why isn't there demand for money? Corporations don't need it. They've got too much. Governments all over the world have been adopting these austerity programs, whether wisely or otherwise, and they've been cutting back on their borrowing. As a result, low demand for money, high supply of money. What happens when demand is high or demand is low and supply is high? The price of anything goes down, and the price of money is interest rates. That's why interest rates are so low, and that's why the commentators who you hear on Fox, should you be so unfortunate as to listen to that network, keep saying about how there's a conspiracy to keep interest rates low and so forth. It's not a conspiracy, ladies and gentlemen. It's the general law of economics. There's too much money and too little demand. Interest rates are the cost of money, and it's very low. I want you to look at the graph of U.S. long-term interest rates in the middle of page 13, because it's key to understanding what I was talking about at the very start when I said that the period from 1950 to 2000 was an abnormal period. If you look at that graph, what you will see is that starting around 1955, interest rates started to go up, and they stayed elevated until about 2000. But if you look at the 100 years before 1950, what you will see is that interest rates were remarkably stable, and long-term rates were stable at around 2.5% or 3%. And I can tell you, although it is not in the graph, that in fact interest rates have been stable for a good deal longer than that. In 1785, when the British government was fighting Napoleon, they issued bonds called sovereigns in British, or gilts, and they were perpetual. That is, they had no fixed term of maturity, and some of those bonds are still outstanding today. When they were issued in 1785, they had an interest rate of 2.5%, and that was the right interest rate right up until the end of World War II. Think about that, a period of about 150 years. Let me reiterate what I said at the very start. The period from 1950 to 2000, when we grew up, when we anchored our expectations in regard to interest rates, when we anchored our expectations in regard to growth, that was the anomalous period. The rest of economic history would indicate that slow growth is what we should expect, and that's probably what we'll have going forward. I could talk, by the way, about why that 50 years was anomalous. There's a number of reasons: the baby boom, the second industrial revolution driven by computer technology, and the educational revolution, in which all of a sudden higher education became accessible to lots of people worldwide. But that's a whole nother lecture. So, what's been the effect of this low growth? We saw it on the price of money. The graph at the bottom of that page is the price of coal. On the facing page, the price of copper. If there's too much money and not enough demand for any commodity, the price of those commodities have gone down. And we can see that effect in Canada most strikingly in the province of Alberta, which I think yesterday came out with a budget projecting a deficit of $6 billion. I can remember, by the way, being in Alberta after the last oil boom, and there were bumper stickers in Alberta on everybody's car, and they said, "Dear God, please give me another oil boom, and this time I promise I won't piss it all away." They didn't keep their promise. The government of Alberta had the opportunity to create a sovereign wealth fund similar to that of Norway, which is the biggest sovereign wealth fund in the world. Instead, they were profligate spenders. Now, unfortunately, the chickens have come home to roost, and those who expect oil and gas prices to revert to the levels that we saw a few years ago, I think are sadly deluded. The world is awash in oil. It's awash in natural gas. It's got piles of coal sitting in ships in Shanghai that nobody's unloading, and commodity prices are going to stay low for a while. So, pretty depressing, particularly if you happen to have a portfolio full of oil and gas and copper and gold, which I'm happy to say nobody in this room does, because we don't own any of that stuff. Last year when we were on this podium, I said, and Barry said, we like companies that are price makers, not price takers. If you're in the commodity business, you are a price taker. Doesn't matter where you get your copper from or your coal or your gas, you're a price taker. You don't get to make the price. But if you produce a good or a service, you're a price maker. You can maybe set your own price. So, how are we going to make money for you if I'm correct and this is the new reality? Number one, don't buy the market, buy companies. People ask us all the time, what do you think about the markets? Are the markets going up? Are the markets going down? Is the market expensive? Is the market cheap? My answer is I don't care, because we do not buy the market. We buy companies. Remember always, every stock is a company. Behind that three-letter ticker is a real company that makes real products and services and sells them. Don't buy the market, buy the company, and understand what that stock ticker really represents. So, obviously, we would like to invest in companies that perhaps can counter this low growth tendency. So, for example, if you look at the graph in the middle of page 15, take a look at employment in healthcare compared to all other industries. Healthcare is the blue line, all other industries are the red line. What you can see is that our aging population, and I'm not just talking Canada, but also the United States and Western Europe, and especially Japan, demands more health care as we get older. We would be stupid if we didn't recognize that even in an economy with no growth, some sectors are going to grow, and in particular, health care is going to grow. We also recognize things like entertainment grow, which is why so many of you have Cineplex in your portfolio, just as an example. Even in a stagnant economy, there are sectors of growth. Our job is to find those sectors, and more importantly, find the companies in those sectors that are going to do well, and that's what Barry's going to talk about when it's his turn. Now, Scott said an important thing, which I want to say is at the core of our philosophy, when he said, Baskin Wealth is not a trading company, it's an investing company. And I want to show you why in the very nice graphic at the bottom of page 15 with the four very pretty boxes. When you buy a stock and sell a stock, you're making two decisions, but in order to have been a successful trade, you have to get both of them right. And your chances of doing that are only 1 in 4. As you can see, there's 4 outcomes whenever you buy and sell a stock. You can buy wrong and sell right. You can buy right and sell wrong. Every now and then you'll get lucky. You'll buy right and sell right. Even then you'll pay capital gains taxes. The odds are stacked against traders. 3/4 of the time they're going to be wrong, and even when they're right, they're going to give the government part of what they made. That's why we don't trade, and that's why those of you who've been with us for a long time will know that your portfolios seldom change more than about 15% in a year. If you own 30 stocks or 40 stocks, at the start of the year, at the end of the year, you're going to own 25 or 35 of the same stocks. If you're an investor, you only trade a stock when you've come up with a better idea or when something has convinced you that your reasoning for buying that stock in the first place was somehow incorrect. We never trade frivolously. We never trade because a stock is popular or unpopular, and God knows we've had our share of unpopular stocks in the last quarter, but we're not deterred unless we feel something has really changed about those stocks. One of the things that's going to be increasingly important as we go forward is buying companies that not only pay dividends, but also raise dividends. And if you look at the chart on the middle of page 16, this compares 5 kinds of companies that you could buy. And this is actual history. This is not theoretical. This is an actual history over a period of 25 years. If you buy companies that don't pay dividends, junior gold miners, speculative biotech, technology companies that don't have products or services, your odds of making money are very low, and all those companies, as you can see, have a minimal return. Slightly better are companies that at least used to have a dividend, even if they cut them. The index is right in the middle, all companies. But the one that you want to own is the company that not only pays dividend, but raises dividends on a regular basis. And if all of you read your newsletter, I hope? The essay on the front page of the newsletter had to do with dividend growers and why they're so important. We have them in Canada, we have them in the United States, they exist in Europe. We are going to be emphasizing more and more in this low growth economy, dividend growing companies, because income is going to become a more and more important component of how we get our total return as we go forward. So the graph at the bottom of page 16 shows you that this is not just a Canadian phenomenon, it's exactly the same in the United States. The blue line is dividend growers, the goldish line is the index. Dividend growers beat it every year over time. That's what you have to own. So, I have a few minutes left. I want to talk about what we expect for different asset classes during 2016 and how we will mold your portfolios. So first of all, I think you know the answer to this already. The graph at the bottom of page 17 shows you the yields on Canadian bonds. Pretty depressing. The fact of the matter is, ladies and gentlemen, nobody's going to make any money on bonds in the next few years. Yields are so low, as I told you, less than 1% for 5-year money, less than 2% for 10-year money. After inflation, if you have to pay tax on that interest, there's very little point. You can't make money. So why do we own bonds at all? The only reason to own bonds is as portfolio stabilizers, to act as a mechanism to keep the ship floating when times get really tough, and to provide income that we know will come, and for people who have liquidity needs and we know we're going to have to take money out of that account. Other than that, we know we can't make money on bonds. Corporate bonds pay slightly better than government bonds, but right now we're struggling to find yields of over 2.5% on good quality corporate bonds. So we are going to be de-emphasizing bonds going forward. Number 2, what do we expect about currencies during 2016? You know, one of the problems about doing this every year and putting it in writing is you could go back and see what we said last year. It's very scary. Last year I said, and last year, by the way, the Canadian dollar was pretty much at par at the start of 2014. I said that I thought the Canadian dollar might go as low as 86 cents. Well, it turned out I was a bit too optimistic. I did not see, and I guess very few people saw, the Canadian dollar taking the huge plunge that it did. We believe the Canadian dollar has been oversold. We believe the true value of the Canadian dollar is probably somewhere around 82 cents. But if the Federal Reserve in the United States raises interest rates and the Bank of Canada doesn't, Canadian dollar will not go up, regardless of what its true value is. If oil prices and coal prices and copper prices and zinc and lead all stay low, the loonie is perceived as a commodity-tied currency. It will be very difficult for the Canadian dollar to rise. So during 2016, we could see the Canadian dollar go up towards 80 cents. From our point of view, the question is, how much currency risk are we exposing our portfolios to when we buy US stocks with 76-cent Canadian dollars? We don't want to lose all that great money we made buying US stocks with loonies at $1 if it goes back to $1. I don't think there's much fear of that. I think we're taking a manageable currency risk of probably maximum 5% during 2016 on our US stocks. Nonetheless, it's something we pay a lot of attention to. And similarly, should we start buying stocks in Europe, which we haven't done since before 2008, we're going to be very cognizant of the level of the euro, which we also think is likely to rise against the US dollar. Although again, if the US Fed raises interest rates, it will be very hard for the euro to rise against the US dollar. So we're paying attention to this stuff, but I don't think it's going to be anything like as dramatic as it was during 2015. So on to the main attraction. What do we think is going to happen with Canadian stocks? We tried very hard, and I have to give a tremendous shout out to our admin staff to get your quarterly reports out so that you would have the bad news for tonight. Everybody had a horrible third quarter of 2015. The good news is we've made more money so far in October for our clients than we lost in the entire third quarter. So if you had a really dismal third quarter, rest assured you've probably recovered all that money. But the point I'm trying to make is this: the Canadian stock market has been dismal, not only year over year, in which the TSX is down 8% year over year from October 31st, 2014 till today, but also down 6% year to date from January 1st to today. It's been a tough environment to make money. The Canadian stocks that we feel are particularly valuable have not been spared. And in that category, I put, for example, the big Canadian banks, which we think are tremendous money machines. It's just been very difficult to make money. We think 2016 will be a considerably better year for the kind of stocks that we're talking about. The dividend growers, the price makers, the companies that have indispensable goods and services and have competitive advantage. We think that 2016 will be much better for Canadian stocks. Our experience in 2015 in regard to the US stocks was better, and most of you will have in your portfolios US technology, some combination of Apple and Google and Microsoft and Oracle and Qualcomm, and some US healthcare. These are sectors which simply do not exist in Canada in an investable way. That is to say, companies that we consider to be of high investment quality. So that's why we buy those sectors in the United States. We think those sectors are continuing to be good places to be in 2016. All you have to do is look at the profits that Apple reported last night, which are simply staggering. And here's a number which I found particularly amazing. During the fourth quarter, Apple's not on a calendar year, but during the last 3 months, Apple had 100 billion downloads of applications from its website. Think about that number. It's an incomprehensible number. That's 16 apps downloaded for every human being on Earth. Now, what that means to us is that Apple is increasingly a vital part of the life of everybody who owns an iPhone or an iPad or a Mac Those people are interacting with Apple on a daily basis, or in the case of our kids, on a minute-by-minute basis, and they're tied to that company in a very intimate way, in a way that we haven't seen in the past. You would talk 30 years ago about a guy being a Chevy guy or a Ford guy or a Cadillac guy, and he had loyalty to the brand, and once every 3 or 4 years he'd go out and he'd buy the car of his choice. This is a much more close and intimate, and in our view, durable relationship than any commercial relationship of its kind has ever been. That's why we're investing in those companies that don't exist in Canada. Aging population demands more healthcare, as we've talked about. That's why we're investing in the healthcare sector. The American banking system, which was devastated during the financial crisis of 2007, has now largely recovered. I don't know if any of you read that Carl Icahn is taking a run at the giant insurance group AIG. That was announced today. All of a sudden, the American banks and insurance companies are an interesting place to invest again. They're raising their dividends. They'll soon be buying back stock. It's a good sector to be in. And finally, multinational brand leaders. These companies have had a tough year because of the strong American dollar. Every profit they make out of the United States translates into a lower number when it's brought back. If we see the US dollar drop, then we'll see those companies start doing better, and that might be a good place to be. So, that's the summary of what I see. Some people call this slow growth scenario secular stagnation. It's a fancy word for low growth. It's the same thing. I see low growth going forward. I see low interest rates going forward, and if people tell you that the housing market in Canada is going to crash because mortgages are going to be 8% 3 years from now, you can tell them Baskin says they're nuts. Probably won't change their minds. But that's not going to happen. Interest rates are going to stay low. We're going to govern ourselves accordingly. So that's the top-down view. I'm now going to bring forward the person who I think is one of the best investors in Canada, and I don't say that lightly, and I don't say it just because he's my partner. He's proven it to all of us, Barry Schwartz, with a bottom-up case.
Okay, I can't guarantee that the two stocks that I'm going to talk about tonight are going to make you money or going to go up, but I'm going to guarantee that this is going to go 5 minutes, okay? So here we go. Last year at our presentation, I talked about the companies that we invest in, the types of companies we buy and how we find them. And tonight, even though I have 5 minutes, I want to talk about patience. Patience is something that is very important as a value investor. Many times we'll buy you stocks and you'll see them and they'll go down and you'll wonder, what are these guys doing? And they keep holding them and they keep holding them and they don't do anything. I'm going to give you an example tonight of a stock that we held for 4 years and did very, very well. It's hard to find a good investment idea. So when we commit to a purchase, we try to be very, very patient. We all know that not every investment idea that we're going to buy for our clients is going to work, but we know if we buy enough good businesses at the right price, we're going to do well over time. And over time is the key phrase here, because we're talking about being patient. Early in 2011, we noticed that Molson Coors was trading at a cheap valuation, and we decided to investigate the stock further. We read a lot of articles discussing how beer sales were in decline, how big beer companies were facing a lot of competition from local and craft beers, and how wine and spirit drinks were taking over. So why in the world would we buy Molson Coors? We looked at the stock valuation of Molson Coors, and it was trading at a discount to its competitors. And it was trading at a discount for very good reasons. First of all, the company was not being aggressive enough entering new markets, and it was not being aggressive enough acquiring new brands like its competitors. So we continued to take a deeper look at Molson Coors, and even with all the concerns about its sales going nowhere, we found something extremely exciting. We looked at the valuation of Molson Coors, and we figured out the company had a joint venture with another company called SAB Miller, and this joint venture, in our opinion, was worth $6 billion. We also looked at Molson Coors' own brands and figured that this was worth another $6 billion. So all told, here is a company that we thought was worth about $12 billion that was trading at a market capitalization of $6 billion. So this made no sense. How could we figure this out? How could we find a company that we thought was worth $12 billion, and yet the market says it was worth $6 billion? Well, you know, good opportunities don't come along every day, and when you find a good idea like this, you have to pounce. And we thought it was just a wonderful, wonderful investment idea. So if you take a look at, here we are on page 23, you'll see here I am in 2011. We bought the stock for you at around $40 a share, and I went on BNN recommending the stock as our top pick. And I confidently laid out our investment thesis. Here's a $12 billion company. It's trading at $6 billion. Everybody, you know, people are wrong. The valuation is there. And you can see what happened a year later. The stock was down 15%. The only thing that went higher was my hairline. And there I was again, 2013, recommending the stock. And in 2 years, the stock had gone nowhere, except for my hairline. And at $45, all we did is collected the dividend. And here we are today. And you see Molson Coors on page 26, trading at $88. And just like Batista, we did the bat flip. So we doubled the investment in 4 years, and we collected 3% dividend each and every year. And obviously, that's a great return. And so patience paid off. And why is the stock doubled? Because Anheuser-Busch and SAB Miller have decided to merge. And if that merger goes through, one of the regulatory reasons will be SAB Miller will have to sell its joint venture to Molson Coors, and Molson Coors earnings should grow tremendously. And even analysts think that Molson Coors can go much higher from here. I'm seeing some price targets of $120 a share. So that's an example of a company that paid off for us over the 4 years, and our patience was well rewarded. And I'm just going to quickly talk about a new investment idea that we bought for you. And since I don't have much hair left on this investment idea, and we'll get into it on page 27, you can see the TMX Group is a recent purchase for us. We started buying it in May 2015 at about $50+ a share. Today it's trading at $46, guys. So let me tell you why we think it's going a lot higher. The TMX Group, for those who don't know, owns the Toronto Stock Exchange and a number of other financial exchanges. And this is a wonderful business. They make money charging companies to list on their exchanges. They make money by each time there's a trade of a stock on its exchanges, and it also charges charges money to subscribers for data about companies on its exchanges. So this is what we call a toll road business. It collects lots of fees year in, year out from a number of different sources. And here we are. Why is the stock trading at $46 when Baskin thinks it's worth $75? We have no idea, but we're going to be patient, and we're going to collect our 3% dividend yield. The company is generating lots of excess cash, and we think next year we'll see a dividend increase. And in the meantime, we note that the company is extremely attractive compared to its peers. Many of its peers trade at much higher valuations and multiples compared to TMX. And remember, value investing takes patience. And as long as we're collecting the dividend and the company continues to get better and better, we think that you'll be well rewarded. So thank you for giving me your patience, and I am done.
So unlike high school, there's not going to be a bell to signal the end of class. But also unlike high school, we're going to serve you alcoholic beverages. Well, most high schools. So thank you very much for coming out tonight in the rain and for being such a receptive and attentive group. Barry and Scott and I will all be available for questions and as we see you later. So enjoy the rest of the evening. Thank you very much.